Hello and welcome. My name is Scott Snyder. I'm the owner and founder of Mellon Money Management, a fee-only financial planning firm locally based here in Jacksonville, Florida. If you don't know about our company, we specialize in student debt planning for physicians, attorneys, really any profession out there that comes out of school with a lot of debt because it is oftentimes preventing you from accomplishing other things like saving for retirement or buying a house. The other group of people we also specifically help are families that are about to send their kids to college and helping them figure out the financial aid packages and properly shop for college, but also figure out what they need to save. So those are kind of the specialties of who we work with, but really today's video is a beginning of a Finance 101 series that I'm starting. And the reason for it is a lot of my clients have come to me in our meetings and said, Scott, I really wasn't sure what you said when you talked about asset allocation or rebalancing my portfolio. Because quite frankly, financial planners, we suck at saying industry jargon and confusing our clients. So that's what this whole series is about, is helping you better understand the things that we discuss so that you can make more informed decisions, because that's really what it's all about, is making good choices with the right knowledge. So today's series is going to look at the difference between a stock and a bond. Most people know what a stock is, in that it's something that you should own in your retirement account and that you put it in your IRA or your 401k, but really beyond that, and it's pretty, I would say, basic knowledge for most of my clients. So we're gonna look at it a little bit deeper there, but I would say a lot of my clients really are not as familiar with what a bond is and what the key difference in traits and aspects are versus a stock. So we're going to evaluate the two, shed a little bit more light on the volatility levels, and return histories over time, and what you can expect, how to better position those for your portfolios as you're gearing up for retirement. Let's first look at what a stock is. A stock is basically an ownership interest in a corporation. And for that ownership interest, you participate in the company's ability to generate profits, as well as the company's ability to manage its balance sheet, which is its assets and liabilities. So all those things factored together help determine the stock's price, whether it moves up or down. And obviously macro events like the Great Recession or the Great Depression are factors that will, at a macro level, decrease the value of a stock, but it doesn't necessarily mean that the stock is, or the companies that are being sold off and driven down in price are necessarily bad companies. Sometimes those companies are profitable, but just the overall hysteria of the markets themselves are what's driving the stock down. Then you have instances where the stock market is on a tear on the way up, and there are companies that aren't participating. Like a prime example right now is JCPenney's and Sears. Those are two companies that, because of Amazon and what its impact has had on online shopping and driving prices down, companies like JCPenney and Sears really haven't been able to compete, and their stock prices have been really hurt as a result. So it doesn't necessarily matter what direction the markets are going. You also have to consider what stocks you're truly buying and what the trends are in those industries. However, stocks as a whole are really considered one of the best asset classes to invest in for people that are preparing for retirement, because of the growth potential that you get with it. Going back to 1928, the stock market, or the S&P 500, which is an index that is often referenced, has averaged an annualized return of 10%, which is really good. Factor in inflation, and that's more like a real return of 7%. So people who now are actually in fact retired still need to have some level of growth to their portfolio and have exposure to stocks, because once your ability to generate earnings and wages are gone, your investments are really the only way to fight against inflation. So it's especially important to make sure that you're not just going to cash or too heavy into bonds, because that can erode your ability to have, it can really erode your purchasing power later on in life, because people are living much longer. And even though you're retiring, say it's like 65 or 70, people are living to age 90, 100. So the ability to generate some long-term growth from your investments is still important while you are retired. Now, I know what some people are going to say that are in their retirement phase of their life that are hearing this, that, yeah, right, Scott, what about when things like the Great Recession happen and the market's down 56%? Well, to that I say, make sure you have enough set aside in cash and bonds that you can tap into before you have to tap into your stocks. So that's the key to this, is ensuring that you have your assets lined up in such a way that you have buckets of money you can go to, so that you're not tapping into your stocks when it's in an opportune time. So what can you expect in a declining type of market? Because that's what really people worry about the most when it comes to stocks, is what happens when the sky is falling. Well, the worst ever time in our country's history is the Great Depression, and that was when the stock market from the very top to the very bottom was down 86%. So it's been a long time since that occurred. That was 1929. However, that is the major risk there. So again, I emphasize the point of making sure that you have enough cash and enough bonds to buffer against those types of scenarios, which I think is highly unlikely in today's world to see something like that. But the point is, you could still, since 1928, the market's averaged annual return is 10%. So it's definitely worth staying in the game in the long run, because trying to time when to get in, when to get out of the market is truly a losing battle. It's when you actually realize the losses and probably get it wrong on both sides. Honestly, you get out at the worst possible time and you get in at the worst possible time. A little bit more about bear markets so that you understand the downside risks. The average bear market has lasted a time span of 15 months, and the average decline is 32%. So keep those things in mind if you're looking at evaluating stocks as your primary source of investing. If you can't handle a 30% loss, then you're probably better suited towards allocating or mixing your investments in such a way that is going to provide a more balanced approach of stocks and bonds. So now you know what a stock is. Let's look at how that compares to bonds and that type of investment asset class. So a bond is really just from an investor standpoint, you're loaning your money to another entity, and in return, they're paying you an interest rate. And depending on the entity, so what entities do you lend to? It's either a corporation, a municipality, or a government. And government bonds have been traditionally considered one of the safest asset classes outside of cash. So with that being said, what you get is you can buy it in different time periods, whether that's 1 year, 5 years, 10 years, 20 years, or 30 years. Those are just some examples, but over that time frame, you're receiving an interest rate, and the longer you're willing to go, the higher the interest rate will be. Also, another factor is the company's credit rating. And much like we are evaluated based on our credit scores for getting loans from a bank, a corporation or a municipality is evaluated the same way, and they're given a rating from all the way down to basically a D, which is horrible, or junk, and then all the way up to a AAA, which is considered investment grade and excellent credit. So the companies that have bad credit are going to have to pay a much higher interest rate because the chances of them defaulting on their debt are much higher. Whereas a company like, say, Amazon or Apple, they're going to have a much higher credit rating because they have been generating very consistent profits. So keep that in mind as you're looking at bond investments. A couple things to consider as you're looking at the history of its returns. The average return of a government bond since 1928 is 5%, which doesn't sound that great, but it still beats the heck out of what you're getting from your cash right now, which is less than 1% probably. So, and then looking forward and forecasting it, Vanguard is actually anticipating that bonds are going to be producing somewhere between 2 to 3% over the next decade, just because interest rates have been suppressed for quite some time. And there's another thing that you have to keep in mind with bonds is as interest rates rise, bond prices move down because bonds, also like stocks, trade in a market, and it's a much tighter spread. So, if you're looking at a stock, the spread is gonna look like this, whereas a bond, it's gonna trade in a much narrower range. So keep that in mind. But if the bonds interest rates are going up, then the bond price, generally speaking, goes down in value. If bonds as a whole or interest rates as a whole are going down, then the bond price is going to go up. Because think about it conceptually. If you own a bond today that's paying 3%, and 5 years from now, that same company issues new bonds at 5%, well, if you want to trade in your 3% bond, somebody's going to pay you less for it because they can now just buy it directly from that company at 5%. So that's sort of how the inverse relationship works there. But also keep in mind that the worst case scenario since 1928 with the bond markets in terms of loss was a 21% decline. So that was from very top to the very bottom, what investors experienced in terms of total return loss. The other element about bonds that I failed to mention is that you as the debt holder are guaranteed your principal back at the end of the term. So when you're buying a bond that's a 5-year bond, basically you'll get your principal back at the end if you don't trade it in before then. So really the only time that it really matters on interest rate movement versus when you own your bond is if you go to sell that bond. So just as you're watching your accounts, it has a much lower volatility level than a stock. And also keep in mind that bond investors will usually, in times of rising interest rates, be pouring their money into the stock market because they see better growth opportunities over there than in the bond market. So, and then the opposite is true with investors who, in a like 2008 type of scenario when the markets were on a rapid decline, a lot of investors fled to safety, which is, cash and bonds. So that was what drove interest rates down for the most part with U.S. Treasuries and other types of debt, and why we had a prolonged period of really low interest rates. So that wraps up the key elements of a bond. Hopefully now you have a better understanding of the true differences between a stock and a bond, and how those two types of investments can mix together in your retirement portfolios. Really understand that stocks and bonds as a whole have not necessarily a negative correlation, but they're not truly correlated with each other. So when one goes up, the other might go down. Sometimes they both go up together. Sometimes they both go down together, like in 2008. So keep those factors in mind, but really the big takeaways are knowing that a bond is much more conservative and a stock is much more aggressive. And by mixing them together, you're trying to match it up with who you are as an investor, what you can tolerate in terms of risk and reward. And I highly urge you to take a risk tolerance questionnaire if you haven't done so before, so that you better understand where you are on the risk spectrum and how much in stocks and how much in bonds you should have invested. Vanguard has a good resource. I also have a tool that I use through Finimetrica, and actually their tool has been proven by academic research to be a better way of aligning one's own risk tolerance with their investments. So without further ado, I hope you've enjoyed the first installment of my Finance 101 series. Stay tuned for more episodes, and thanks so much and have a great day.